Hey, it's Rav. Welcome to the Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. The challenge often is that we take our precious time, we go to work, we get paid in order to eat. But imagine a life where money could make you money so that you could work a little less, have more time for those things that matter most. Family, friends, engaging in some sort of purpose greater than yourself. That's what this show is all about, teaching you how to grow your money. Don't go anywhere. We'll be right back.
Yeah, I mean, generally speaking, it's not by accident that we invest heavily in the GTA. I mean, we invest across North America, but our largest holdings are in the Greater Golden Horseshoe, the Greater Toronto Area, the Downtown Core, all those things, for specific reasons.
Hi, it's Darren Mitchell from Control and Compound. If you're a real estate investor or business owner, you know the cookie cutter approach to financial planning doesn't work for you. You've got to be in control of your money. You've got to save and store your money differently than other people. At Control and Compound, we are the wealth coaches for real estate investors and business owners. We show you how to save your money, grow your money tax-free, multiply your money tax-free, and spend it tax-free. To learn more, please check us out at controlandcompound.com/everydayinvestor, where viewers of this show get a complimentary education session.
Hey, it's Rav. A few years back, I learned about trading stock options by taking the Theta Trading course. My son, my friends, myself, all of us benefited immensely by applying their strategies, and I want you to have that same benefit by taking their course as well. I'm not receiving any monetary benefit whatsoever by telling you this. It's just that, as you know, I believe that knowledge mitigates risk. Visit their site to find out more.
Hey, it's Kyle Ford from Canada's Mortgage Choice. I want to talk to you guys about your upcoming renewals. On average, your existing lender will send you a renewal about 6 months in advance. It's absolutely critical that we don't just sign and accept the first offer that we get. Before you talk to that original lender, reach out to myself and team here at Canada's Mortgage Choice. We can help analyze your current situation, your current lender's offering, as well take it to the market and compare with the other options. More than anything right now, it is not all about interest rate. The most important thing to my clients is their monthly payments. And when you compare just your mortgage rate with all or any other debts that you may have, paying a slightly higher rate or restructuring your overall debt portfolio may be able to lower your monthly costs and give you payment stability for the next couple of years. If this sounds like something that we can help with, make sure to reach out to myself and team here at Canada's Mortgage Choice.
Hey, it's Rav. Welcome back to Everyday Investor. I am super excited about today's episode, super excited about today's guest. One of my great friends, Peter Politis, is with us. Peter, thank you so much for taking time out of your busy schedule and joining us here on the Everyday Investor TV show.
My absolute pleasure, Rav. Good to see you.
Yes, good to see you too. You know, here we are in 2023, kind of in the spring and going into summer. And you know, I can't believe, Peter, it's been 11, 12 years since you sat in my living room and introduced to me this whole concept of development. I mean, you know, I was 16 years old when I was in a co-op brokerage, real estate in Kingston, Ontario, and I thought I had learned everything that there was to know about real estate investing, and you introduced me to a concept where, hey, Rav, if you want to know how the billionaires make their money, let me introduce you to land development. I've invested in, you know, over 10 different deals. And then you brought me in to join you at Greybrook in the business development world. And so I'm just so grateful, the friend that you've been to me and my family. But enough about our relationship. This show only has 22 minutes, as they say. Tell me about Greybrook. I mean, there's so much that you do, whether it's, in helping people to invest in apartment buildings, land development, and within land development, townhomes, semi-detached, big, detached. We're in the States. We're doing what's called society living. I mean, people can go to greybrook.com and learn all about that. But for the purposes of this show, let's talk about Greybrook and the GTA and what we're doing past, now, and future in the GTA.
Yeah, I mean, Greybrook has a pretty simple thesis when it comes down to it, is that we think that there's a very appropriate risk-adjusted return to be made investing through the development process, obviously both in the GTA, but as you said, we're North America-wide. But specifically in the Greater Toronto Area, the idea of buying land, taking it through an approvals process, and either selling approved land or building, whether it's a low-rise or master plan community-like homes, townhouses, or detached houses, or condominiums that range from smaller investor-geared condo developments to large end-user luxury product in Yorkville. We think there's a really good manufacturer's margin to be made doing that, and our thesis and our belief is that we should allow people of all different size investors to participate in the value creation activities of these developers in different proportionate scales relative to how they like to invest.
I mean, people come to me all the time and they say, Rav, can I please get in on these Greybrook deals? And I say, sure, we'll send you when a deal offering comes about, but you've got to react quickly. I mean, we're now over 10,000 investors across 40 some countries. I mean, it's crazy, and healthy returns. What are kind of projected returns that we shoot for?
Yeah, so I mean, we do different things in different areas. So obviously the return metrics will vary, but on the development side in the GTA, our goal is to basically double our money every 4 to 5 years. So on a basis, we're looking to double our money every 5 years. Of course, the duration of projects will vary depending on size, location, and planning state. So we can have stuff where we're buying service lots or ready to go low-rise land in there, kind of 2.5 to 3.5 year periods, which are smaller developments. I would say that's a minority of them. Typically, we take land through an approvals process. So building a master plan community of 300 to 100 to 600 homes could be a 4 to 8 year process, depending. And condominium developments these days are typically somewhere between 5 and 7.5 years, depending on the size and shape. So obviously, if they're a little bit longer, we're trying to get slightly higher returns. If they're a little bit shorter, slightly lower in terms of total dollars basis.
And what I love about it, there was a time where I tried to, pick up a hammer. I wasn't very good, says my wife. But now I don't have to do that. I can be very passive. The developer does all the work. And Greybrook, Peter and his team, are really the boss. They're the asset manager of Rav's money and help Rav's money grow. And it can be diversified, like we said, in different type of investment vehicles. I mean, that's what I love. It's a very passive investment for the investor.
Yeah, it's funny you say that. So, I mean, we co-manage a lot of all these developments with our development partners. I think 2 heads are better than 1, and you're a better man than me attempting to pick up a hammer because I know what my limitations are, and I didn't. But most of the time when people invest in real estate, it's an active investment. And I think when I speak to a lot of people, either they don't want to have an active part, they're maybe nervous or scared about the active part, don't have a lifestyle or time in their day to have an active part. And that's what's the barrier to entry for most people in real estate. But for me, I take it one step further. Even if you have the time or the expertise and the willingness, I would like my money to work for me. I don't want my money to buy me a second or third job. Not to mean that there isn't value in working and adding value when you make your investments in real estate. We've all done that. That's where my family got it started in real estate in the exact same way. But this really allows you to make an active-like return on projects that have the largest economies of scale, partnering with Greybrook, who's done over $30 billion of development and over 100 projects with some of the biggest residential developers in the country on the projects that have the largest economies of scale. But for you, whether you're investing through your RSP, TFSA, through a corporation, It's tax efficient, and you don't have to go to work every day. Unless you want to, in which case we're happy to put you to work.
And you know what's interesting? I mean, I tell people, and that, you know, they know that anyways, that kind of in the land development space, you know, Greybrook is the Cadillac of investments. We're playing with the big boys. You know, your development partners are the biggest names, you know, in North America. And then little old Rav and friends get to, you know, be part of this. And that's what's, you know, very exciting. Why that strategy? Because you could go to pension plans, you could go to the big banks, you don't need, you know, everyday people, if you will. But I'm grateful that you guys do that. What was the thinking and the strategy way back, you know, a couple decades ago when we were doing this?
First of all, we do work with pensions, we do work with banks, and they sometimes invest alongside individuals like yourself. When I started, next year is going to be, now I'm somewhat dating myself. Next year is going to be my 20th year doing this. So I started when I was 2 years old, and I'm 22 now. No, and this was not as well known an investment vehicle. Alternative investments were not nearly as pronounced as they are today, and there wasn't a lot of different kind of investing that was as common. So while you had some institutions that were willing to do it back then, you had less that were willing to do it. We were doing it on a larger scale. So we thought it was a good vehicle, and we would go to our friends and family and individuals, and obviously that grew. Today, all the people that you mentioned do invest with us. In fact, they invest with you in some of the deals that you're in. They're pensions, they're banks, they're money managers, they're some of the biggest investors in the world. But it doesn't mean that now that they're also doing it, that the 10,000 plus people that we've worked with for the last 20 years aren't important to us. We're not part of their portfolios. Their investment strategies haven't been, at least in part, involving this for a long time. You know, we maintain those relationships and grow those relationships and do a lot of it. I mean, we invest hundreds of millions of dollars of equity a year. In terms of total dollars, either from a development value or from an equity perspective, there's no one who does what we do. So even if you're a billionaire and we're investing hundreds of millions of dollars a year, billionaires can't keep up with how much money development costs these days.
And on most projects, yeah, no, great point. I knew that they did that, but I was also just very grateful that Rav and friends could invest as well, because correct me if I'm wrong, but our minimum investments generally are around $25,000, and we can use for most deals, you know, registered funds, whether it's a TFSA, RSP, and so Rav can get in for $25,000, and then, you know, there's professional athletes, there's, you know, big wigs in different countries, you know, politicians, if you will. There's, you know, and then there's the teacher, and then there's, so the return on investment, if somebody puts in $1 million and somebody puts in $25,000, the return is the same.
Correct. The proportionate return is the same for everyone, whether you invest $1, 10 cents, or $20. So it's not relative to your return. You just own technically a bigger or larger percentage of any one project. And I think it's important for people to know that when they're making an investment, they get to choose the project that they're invested in or the number of projects. So it's our job to create what I like to refer to as a diversified real estate portfolio on the development side for people. So if they want to invest $1, we try to put 10 cents here, 20 cents there, 30 cents there, 15 cents here. Projects that have different durations, that are different project types, different development types, and different time durations. So that's how we try to create a diversified portfolio, but someone's not making a blind investment into the company of Greybrook and, you know, you don't know what you're buying. You're buying these individual projects on a project by project basis. And it's also very tax efficient within a corporation. Like if you're a Canadian, and you're investing vis-a-vis a corporation, which a lot of us do for real estate, it's active business income, which is a lot better taxable rate than, let's say, passive business income or passive investment income.
No, fantastic, Pete. We're going to take a quick break, but if I am watching this show and, you know, it's airing here in July 2023, the question begs, the state of the economy, and your thinking around all that in the GTA. So let's address that when we come back from the break. Talking to my good friend, Peter Politis. Don't go anywhere. We'll be right back.
With the uncertainty we're currently experiencing in the investment landscape, It is an oasis in a desert to find a place where you can get not just one, but 7 different opinions in different investment streams, all for you to explore in just one day. On October 28th, Toor, myself, and 5 of our friends are hosting the Everyday Investor Summit, where we're going to teach you multiple ways where you can safely and securely invest your money in the world of uncertainty that we're currently experiencing.
Mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Do you know the difference between an or asset and an and asset? Just about every investment you're going to have is an or asset. Do I put money in an RSP or a TFSA? Do I put money in my business or real estate? Do I join this real estate investing group or do I get a coach? One or the other. An infinite banking policy isn't your only and asset. Your money goes in the policy and grows tax-free for the rest of your life. And you can leverage 90% of that to go take advantage of opportunities. Your full amount still in the policy, you're taking advantage of another opportunity, and you're providing a death benefit. Your money's in 3 places. We've multiplied money just like the wealthy. To learn more, check out controlandcompound.com/everydayinvestor.
Hey, it's Rob. Welcome back to Everyday Investor. We're talking to Peter Politis, good friend, smart guy. Peter, thank you for being on the show. We're talking a little about the workings of Greybrook, and for more information, guys, go to greybrook.com. It's right there on the screen. So the question begs, Pete, is what everybody's wondering is the market, the economy, interest rates, inflation. I mean, all that kind of stuff. You've always sat down with me when I've had questions, and I walk away educated, nurtured, resolved, satisfied. I want you to just kind of share with the viewers. You say, Rav, this is not flipping a house. It's not like you have to time this within a few months, that's not the way this works. So teach us about how this manufacturing industry works, if you will.
Yeah, I mean, generally speaking, it's not by accident that we invest heavily in the GTA. I mean, we invest across North America, but our largest holdings are in the Greater Golden Horseshoe, the Greater Toronto Area, the downtown core, all those things, for specific reasons. Canadian immigration, which is the driver of the growth of our country, is very strong. And in fact, over the last few years, it's materially increased to now over 500,000 people a year of, let's say, legal counted immigrants. There's lots of subsections of people that come here that need a place to live that don't even fall under these immigration numbers through temporary stays, other things like that, students and all those things. So the demand for housing is so real. The Greater Golden Horseshoe, the GTA specifically, get half of that immigration. So we will have instances, and we have, where the market will speed up and it will slow down, whether it's through interest rates, government intervention, global pandemics, and different things. But the steady demand over the long period is there. And for my entire career, I've seen it where you sometimes will fast forward sales, like in post-COVID, super low interest rates, savings was high, a number of housing sales were hitting record high. It's not an accident. They were slower before that. Now they've slowed since, and they are, and I'll talk about where the market is now because it seems to be picking up again, not immaterially in some cases, where you fast forwarded some sales, but now that you've seen some period of slowing, all you're going to do is over 3, 5, 7, 10-year periods, which is how long we really invest for and development takes. The amount of housing demand that exists is pretty consistent, and it's a growing demand, and we have a big supply issue. So, of course, I have the conversation, you're buying something, and whether the market is amazing or less than amazing at that given time, we might not be selling a home, a townhouse, or a condo for 1 year, 3 years, 5 years, 7 years. People don't often ask the question, what do you think the market's going to be like in 4.5 years when we're starting to sell this? They think about what the market is now, good, bad, or indifferent. And for us, it's a more detailed thesis than that. Is we understand the supply-demand imbalances. We understand that if you have the right inputs, you can make a manufacturing margin at various price points. And one of the best things is that if for some reason we're at a point in time where it's not even whether you can or can't make a profit, it's whether you think the profit is justifiable for you to go now, we can always wait. We'll sell in 6 months. We'll sell in 12 months because we know that the market is going to be there sooner or later. And I think that is the underlying premise of the GTA, is that the demand is so strong. External global factors will create periods of house sales more or less, but the demand is very strong. That is kind of the evolution of the market as a whole, kind of how we're seeing it now. Obviously, interest rates are as high as they've been in a very long time. We do think that sometime next year they're going to start coming down and going to normalize at a level below this. But the interesting thing is a quarter point increase in the rates today means a lot less than it did a year and a half ago, when that would have been a 25 or 30 or 50% increase in your borrowing rate, in the borrowing.
Yeah, no, well said, Pete. I mean, economics 101, what I hear you saying is when you have more demand than supply, we're in business. And we happen to be manufacturing. I mean, we could be manufacturing automobiles. We could be manufacturing phones, cell phones. We're manufacturing housing. And there is demand, more demand than supply for housing. We can't keep up, actually. And so, no, it's a great answer. And, long term, and I'm in deals that are 4 or 5 years. I'm also a deal that's 15 years. Like, it's if the economy happens to be dipping right now, I hear you saying we just wait, because there's the margins are so healthy that we still win. And this is not a fund. It's not like I'm putting my money in and, it's across everything. I mean, these are specific projects that Rav gets to decide on whether he wants to invest or not. And I love the fact when people say, Rav, don't you want to be diversified? I said, you bet I'm diversified. I'm investing in the States, Invest Canada. I have, apartment building, whether it's a condominium, a detached, and with different developers. And Greybrook is my asset manager, if you will.
Yeah, I mean, I think for us, it's amazing how many subsections of areas there are to invest in the different product types. The person who's buying a townhouse from us in Oshawa is maybe not the same person who's buying a 6,000 square foot estate home in Kleinburg, and still may be a different person than buying a bungalow in Hamilton, and is definitely a different person than is buying a 500 square foot condo in Liberty Village or a $10 million luxury condo in Yorkville, as an example. And I think for us, we've seen different points in time where the single family housing market is doing something a little bit different than the condo market. And by diversifying through product type, locations, geographies, we feel we can create a balanced portfolio that has different types of exposures that over the long run is going to be very financially successful. And the other good thing that we've learned and our investors have told us over the years is it's a repeatable strategy. So what I mean by that is you can in your head, you can say, I want to invest in this on an ongoing basis. And sometimes you invest for 1, 2, or 3 years, and projects start finishing and people start rolling over other projects. And it becomes a part of your portfolio and saying, I bought a deal with Greybrook and developer X in Y location. Of course you can, and people do. But to think of it as a portion of my investment portfolio is going to go here in this strategy. I will have access to these deals, on an annual basis, on a regular basis, and I can really contribute to this part of my portfolio.
Yeah, no, fantastic. So in terms of the investor, our projected returns, we're looking to double somebody's money, depending on what product we're doing. Just a little different for apartment buildings than land development and so on and so forth. But generally, double money every 4 to 5 years kind of works out to a projected, annualized return 20%. Minimum investments generally $25,000. We can use our registered funds for that. We only have a few minutes left, but it's a great question to always ask when any time somebody offers you an investment opportunity. You always want to also ask, what's the downside? What would be the potential risk? So I ask you, Peter, as well. What do you say when somebody says, okay, Pete, so what would be potential, if any, downside with something like this?
Without getting into the super detailed nuances, because people have been doing development in different shapes and times since the beginning of time. Who you do it with, how you're capitalized, what kind of land you buy from an entitlement standpoint, what kind of balance sheet and cash you have as a developer and a company doing it. All these things can have drastic sways in the risk profile. So on the surface, someone could be putting two things up against each other who isn't an expert or really detailed area, and they look the same. And I can look at something that has 50 times more risk than something over here. And I think that's the biggest thing that we do is that I would say the biggest risk in what we do is typically time and illiquidity. It's that things can take longer, which typically add accretive value to it. It's a 5-year project. In 5 years, no matter what, it's going to be done, guaranteed. That's not necessarily the case. But we don't take entitlement risk. It's not like we're buying a piece of land that's swamp in, wherever, or the desert that we're trying to build houses on. Like, we're buying lands that have entitlements and have rights and have the ability to build this housing. Of course, you have to go through an approval process to do it, and that can take time. But it's typically time and illiquidity. If somebody needs their money back in 3 years or something bad will happen, it's probably not for them, right?
No, but on that point, Pete, sometimes, and I've experienced it personally, might be delayed, but I'm actually making more money by the fact that it's delayed. And so,
I think the important thing to make as a distinction, just because you said that, and I want to be clear, is we share the profits equally with our development partners, right? So when they make $1, we make $1. When they make $2, we make $2. We're not lending the developer money. We are equity. We are co-owners of property with them. So typically, in the normal course, time does mean more total dollars as markets go up, as things change. So that's a very important point that you just made, is that we're not a lender of money. We're not financier. We are co-owners and are sharing equally in the development profits with all these developments.
Yeah, as much as I'm not going to pick up a hammer, I can pretend. I'm allowed to put on a hard hat, the boots, and walk around because I am partnered in this development, Pete, listen, this has been a great show. Time flies when I'm being nurtured, when I'm having fun. Thank you so much for being on with me. Really appreciate your time.
Always a pleasure. Nice to see you. Thank you for having me.
And now it's time for our investing tip of the week.
So today's teaching is about a very common question that I get about the fact that the rent-to-own strategy is more people-focused than property-focused. And I think that stumps a lot of people. So what do I mean by people-focused? Well, when the average investor thinks about real estate investing, they start to think about location and the type of home or the type of property, whether it would be pre-construction or a resale duplex or a resale detached home. But with rent-to-own, we start with the people. And oftentimes, these people have great income, great down payment, but they just don't have all their ducks in a row for the banks to say yes to them. And these people also have a burning desire to become homeowners. And that's where the rent-to-own strategy can help them. The rent-to-own strategy essentially gives these people a little bit of time and a little bit of guidance and a little bit of help to become mortgage ready while they're building up a bigger down payment, while they're becoming mortgage ready, and also in the interim while they're building up a little bit of equity through the rent-to-own process. At the end of the day, the rent-to-own strategy is all about getting these people to a finish line, to a successful outcome, and to become owners of that property. So it's the people that we focus on. We qualify them based on their income, based on their down payment, and we determine whether they're going to need 2 years, 3 years, or 4 years to become mortgage ready through that rent-to-own process. So it's always all about the people. People first, property second. And that's today's teaching. See you next time.
And thank you guys for watching. Without you, we would not have a show. If you want to see this show again or you want to see any of our other shows, make sure you go to everydayinvestor.com. You can watch them there, click on episodes. It's like watching on demand. Make sure you also sign up to receive the episodes right into your inbox. Look forward to seeing you next week. Same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.